Hi, this is Matthew Cratter from Trader University, and today I want to talk about the Fed, the new coronavirus vaccine, and what this may mean for the stock market. If you're interested in learning how to make money in bull markets, bear markets, or just want to see what I'm trading and investing in, be sure to hit that subscribe button. So the stock market has a way of making fools out of all of us. Yesterday I just put out a video called Is a V-Shaped Recovery Coming?, in which I argued that all the components of the S&P 500 that would benefit from the end of the COVID lockdown and a reopening up of the economy were really underperforming the big FANG stocks, the big tech stocks that really did well whether the economy was opened or closed. And so I made this, and I use this as an argument to suggest that even though the S&P 500 had recovered a lot, the individual components were suggesting that we were still not anywhere close to a V-shaped recovery. So what happens today? Today, the NASDAQ 100, which is mostly really weighted toward the big tech stocks, the FANG stocks, that is up 2% roughly. The NASDAQ composite is up about 2.7%, and we really have a flip or an inverse of what I was demonstrating has been happening so far this year. So the Dow Jones Industrials is up 4%. S&P 500, which has a lot of big tech stocks in it, but also has a lot of what we used to call old economy stocks, is up 3.5%. And then the Russell, which is the smaller cap index, has a lot of financials and maybe riskier companies, especially riskier in a recession, is up almost 6%, 5.84%. So we have the complete opposite happening that has been happening this year. We have an outperformance of industrial stocks, old economy stocks. You could even call it real economy stocks, physical world stocks as opposed to digital world stocks. If we look inside the Dow 30, we can see that some of the tech stocks like Microsoft only up 1%, Walmart only up 2%. But if we scroll to the big movers here at the bottom, we can see that it's mostly stocks that would benefit from a reopening of the real economy worldwide. So Caterpillar, Walt Disney, obviously, ExxonMobil, crude oil is up huge today. Boeing, maybe more demand for planes if the airlines can survive and if people start flying again. So you could see this as old economy out-rallying new economy. And if we look at the market heat map, we can see something similar where Microsoft just up 1%, Apple up 2%. If we look under the industrial stocks, we see just a ton of stocks that are up 5, 6, 7, 10, 13, 14%. Huge moves. Also huge moves in the banks and the financials. JP Morgan up almost 6%. Bank of America up 7%. Wells Fargo up 9%. Energy stocks up huge. Exxon up 8%. So you get the idea. This is sort of the inverse of what's happening. It's sort of a catch-up rally in the stocks that have been underperforming in a closed, shut down COVID economy. Now there's one main reason that's given for this, which is that Moderna announced that the early trials from their human vaccine for coronavirus is looking promising. Now it looks like they're still going to move to I believe it's a phase 3 trial later this summer. But it does show that the vaccine can create an immune system response that fends off the coronavirus. Yeah, the company plans to take shot into phase 3 testing in July. This still means that the vaccine is some ways off because even after you do the human testing, even if it gets an accelerated FDA approval, you actually have to manufacture a lot of doses and distribute them. Maybe we can get this done before a resurgence of the winter. That'd be great. But as you all know, the stock market doesn't price in today what's happening today. It tries to be much smarter than that. And it tries to price in what's going to happen tomorrow and the next week and the next month and maybe even the next 6 months. So this is the main reason that's given for the rally today. And obviously it's playing a huge part. Moderna is up just skyrocketing on the news. This could obviously be very good for their business. But I would suggest that there was another news item that's really moving the market even more. It's a little bit under the surface of the headlines. And that was a 60 Minutes interview with Jerome Powell, the Federal Reserve head, that aired last night on 60 Minutes. Scott Pilley was the interviewer, and here's some of the quotes from it. You simply flooded the system with money. They talked about the Fed's response to the financial system crisis in March, Powell responds, yes, we did. We printed digitally. As a central bank, we have the ability to create money digitally. And we use that money to buy treasury bills and bonds, other government securities. We also print actual currency and distribute it throughout the economy. So this is the money printing we've been talking a lot about if you follow my channel. And but to have Powell come out on a major news program, and I mean, it's really unbelievable that we create new money. This is a really bizarre fiat system that we're living under. But this his second question and response was really the big one. Pelley later asked, has the Fed done all that it can do? And Powell responded, there's a lot more we can do. We're not out of ammunition by a long shot. They have taken interest rates essentially to zero, but they can print an unlimited amount of money. They can use it to buy bonds, maybe even stocks someday, and they can also print money, give it to the Treasury, and that can be distributed as sort of UBI checks, free money like a lot of Americans got, those $1,200 checks earlier in the year. And then he says there's really no limit to what we can do with these lending programs that we have. And what Powell really wants Congress to do, and this was what I took away from the interview, he wants Congress to spend a lot more money so the Treasury can issue a lot more debt, a lot more treasuries, and so the central bank can buy them. And that's really what he's talking about. This is the main lending program, where the Fed prints new money, creates it out of nothing, and uses it to buy treasuries, uses it to buy mortgage backs, etc. So I think this is the real reason behind the rally, just this really making explicit of the Fed put, the protective put that lies behind the stock market. And so what I would say, if you ask me my best guess today, I would say the bear market is over. We'll be at new highs on the S&P 500 within the next 6 to 12 months. Barring, for example, a really severe mutation of COVID that starts killing. I mean, if we get a mutation of this and it comes back in the fall and it starts killing healthy young people, obviously all bets are off. But if we sort of continue on the same course, it looks like, as I've been suggesting over the last couple of weeks, that the Fed does not want there to be a deep bear market like we saw in 2000 to 2002 or 2008, 2009. Now we're at a really key level in the S&P 500 today, up 3.5% as we said. But this sort of 295 level is significant. This is where we bounced off in the fourth quarter of 2018. The market had been doing well until then. The Fed started rolling off its balance sheet, and the market immediately took a dive, bouncing off these levels. Something similar happened in the spring of 2019. And in both of those cases, it proved to be temporary. We had, especially the second time once we bounced above, we chopped a little bit around these levels, and then we really had that amazing third and fourth quarter rally of late 2019 before COVID hit, and really extending into the first couple weeks of 2020. When we had the initial shock down, as the news about COVID began to really trickle out of China and begin to affect other countries like Italy, we found support at this level. These are weekly bars of the S&P 500. And so now we can see that after a real V-shaped excursion, we're back to this level, and we're sort of testing that level. A definitive close above this level, I think, would be strong evidence that, or strong confirmation that we're moving higher. If we fail at these levels, maybe we get another leg down. And you can see that we've had this bearish, we had the death cross, the 50-day moving average here crossing below the 200-day moving averages, which is the red line. We're still below the 200-day moving average, so we're not out of the woods yet. But a strong close, especially I would say 2 days close, 2 daily closes above the 200-day moving average, which is currently at 299.43. So 2 closes above that, I think, would be another sign that what we're seeing is a little bit like what happened in late 2018, early 2019. Where we got the bearish crossover, we had a V shape, and then the market recovered fairly quickly back up to the red line. And once we got above it, you can see that there were a couple excursions back to it, but we really began another whole leg up. And this is one reason I think that we could see another new whole leg up in the coming 6 months, coming 12 months. Now, what would be how would this be similar to 2008 or 2002? So let's look at a similar chart. This is 2000. This financial crisis, the popping of the housing bubble that began really in late 2007, accelerated in 2008, and then of course Lehman filed for bankruptcy in the third quarter of 2008. But in the first stages of this sell-off, we actually did get a rally back up to the 200-day moving average line. We actually got 1 day close above the 200-day moving average line. We bounced off, and the selling really accelerated then. So that's why I'm saying I would want to see 2 days close above the 200-day moving average to really confirm that this rally has legs and is not a bear market fake rally. I'm going to scroll out here to give you a little more context here. So we had sort of a double top in the market. This was the top in September of 2007 as housing markets began to weaken in California and Florida and Nevada. And we had the first leg down, which was not as sharp as what we saw in February and March. We saw just a real crash. It was more sort of 1929-like. Then we had high volatility, high VIX. Obviously, you can tell by these daily moves. And then that just single close above the 200-day moving average. If we see two daily closes above the 200-day moving average this time, especially considering we have the Fed put, I would say that'd be a strong argument that we see new highs. So let's look at a similar bear market in 2000 to 2002. This is really the popping of the blue chip bubble. This is when GE and Coke were trading at their highest PEs ever. We had a death cross, moving average crossover in late 2000. And sorry, this is when March 2000 was when the NASDAQ, the dot-com bubble, began to burst. We had a fairly sharp descent, and we never got back above the 200-day moving average until really after September 11th. I believe this is the crash down here. After September 11th, we had kind of a relief rally, and we had a couple daily closes above the 200-day moving average. I'm going to scroll in so you can see this. But this was a little bit different. This was much later in the market. There had already been a huge amount of carnage. I mean, we had sold off from, call it 150 on the SPY, and we were already down to, we got as low as, call it 97, 98. So it was much later. It was really, call it 15 months, a lot, not just 2 or 3 months as we've seen this time around. So I think this case is different. We possibly could see something like we saw in 2008, but I'm willing to bet that this is more like what we saw in late 2018. Simply because we're at a different point now. We have baby boomers much closer to retirement. We have tax revenues levered off of capital gains. We really cannot have a stock market crash or an extended bear market. It's very important to reflate equity prices as quickly as possible so things don't break. If we start to stay down here for a long period of time, the whole system could break. So rather than having the system break quickly, what the Fed is doing is they're buying time. They're going to let this financial system break slowly. So to rewind, we had in 2000 to 2002, we had the popping of the stock market bubble. The Fed was able to reinflate the economy by causing the housing bubble. When the housing bubble popped and all these banks almost blew up, we had to take the bubble to the next level up. So we went from stocks to the banking system, the housing bubble. Once that blew up, we took it up a level to the sovereign debt level, where we were basically levering up. We were allowing the consumer to delever, the banks to delever. So for example, the US banking system is much healthier now than it was in 2007, 2008. But the bigger sovereign debt level is in a much more precarious position. Our debt to GDP levels are in a much more precarious position. As a result, the Fed has to just print a lot of money, and it has to use that money to expand its balance sheet by buying treasuries. We no longer have net foreign buyers of our treasuries. Basically, one arm of the government, I know people don't like when I say the central bank's part of the government, but call it one arm of the leading authorities, has to print money and buy treasuries, buy sovereign debt, U.S. government debt, from the other arm of the government. So this is what happens. And so the only real way out of this is for the U.S. government to default on its promises, to not pay Social Security, to not pay Medicare, to not pay back holders of Treasuries. And Trump has sort of jawboned that maybe we wouldn't pay China back on its Treasuries. I don't think any of this happens. You can't not pay the baby boomers their Social Security and Medicare. You simply cannot do this. And I think there's a 0% chance of that happening. I think everyone gets paid. China gets paid back. Everyone gets their Social Security and Medicare. But what we do instead is we trash the currency by printing too much of it. And we can see that's what's been happening here with the M2 money stock, one of the forms of the money supply. Now, this doesn't mean we get price inflation immediately, but what we do have is basically currency inflation. We're printing a lot of money, and that in that way devaluing the money, the cash that everyone is holding, and we're driving down the purchasing power of the US dollar. This is sort of a secret way to get out of this problem. And so what I would suggest is that if we do see another leg up in the stock market, you'll be making money. Maybe you'll be making 8% a year or 9% a year, something maybe slightly below the historical averages. But the value of the dollar will be going down faster than that in your actual purchasing power. So if, for example, one share, quote unquote, share of the S&P 500, today would buy you a tenth of a car, maybe in 5 years from now, the stock market will be much higher. But that same single share of the S&P 500 will only buy you 1/15th of a car or 1/20th of a car. And so this is the way out of a sovereign debt bubble. This is a way out of all of our unfunded liabilities, paying the boomers at retirement, paying off all the external debt that we have, or being able to roll over our external debt. Basically, the Fed will buy it all. The Fed is going to save us, but they're going to trash the currency in the process. Not a lot of people pay attention to currency, and so workers are going to keep getting raises in their wages. Everyone's going to feel good. Your portfolio is going to be higher every quarter. You're going to get raises at work. But unfortunately, maybe the price of gas will go up a little faster than that, or the price of food. We may eventually, especially if we do UBI checks, see kind of consumer price inflation. But either way, what we have is monetary inflation. That's one reason I'm so bullish on gold and Bitcoin. I think they do well if the stock market rallies a lot, because the only way it can rally a lot is through the Fed, this sort of Fed put. And whenever there's a hiccup, the Fed is going to have to buy junk bonds. They're going to have to keep buying treasuries and mortgage backs. They have to buy mortgage backs to make sure the housing market doesn't crater, and then make sure people can still get financing on their homes. But in the process, the US dollar will be weakened over the next 3, 5, 10 years. Gold is going to go up a lot. I like the gold miners, GDX, and I think Bitcoin is going to go up the most in this sort of environment. So I would sum this up by saying basically the Fed is injecting the stock market with a new special vaccine. That vaccine is not a COVID vaccine, but it's the printing of money. And so rather than doing a hard default where we don't make good on our promises, we're going to do a soft default. We're going to pay everyone off, including the stock market, with devalued dollars. Hope you guys found this interesting. Please hit the subscribe and like button if you did. And let me know your questions, comments in the comment section below. Thanks a lot for listening, and I hope to see you in the next video.